All right, welcome back to the channel and happy Thanksgiving weekend. Hope you guys had a good weekend, but we're back into it with Paylocity this week. Ticker symbol PCTY, and we can see that recently it's been in a bit of a pullback. So I know Paylocity and Paycom have been mentioned over the last, I don't know, what was it, like year and a half, 2 years, I don't know. I think somebody was calling the bottom right around here. Somebody out there, I don't know, and then it kind of rallied, and now we're back down to 150 or so. At least they were calling the bottom of Paycom, and that one's even worse. We look at that one. That one was like that was fun. Let's see. Let's let this load. Yeah, I think they were calling it right here. So like really rough. Or actually, it might have been right here. I don't know. One of these 270 areas, they're like, oh, I think it bottomed, and then it dropped down to like 145 for a little bit. So did a Paycom video. Now we are on to Paylocity, PCTY. So we can see that it is in a bit of a pullback, kind of testing those previous COVID highs right here at around 146, 150. It's at 150 right now. I think it went down to a low of about 145, maybe a little bit lower, maybe around 140. And we can see that it's been a pretty good growth machine over the last 5 years. Revenue growth over the last 5 years, about 25.48% average. Net income growth, even better, 29.55%. EBIT growth, 56%. Free cash flow growth, 28%. Operating cash flow growth of 23%. Now, over the last 5 years, it has had yield multiples for net income yield of average of about 0.97, 0.99 for EBIT, free cash flow of 0.97, and operating cash flow yield of 1.85. On an LTM basis from where it's currently trading, we're at about a 1.7 net income yield, a 2.3% EBIT yield, a 3.01% free cash flow yield, and a 3.85% operating cash flow yield. On an NTM basis for analyst estimates, we're sitting at about a 3.32% net income yield and a 2.53% EBIT yield from analyst estimates. So yeah, it's been priced pretty rich for the growth. This is a this is a human capital management company. So think like payroll, 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 time card tracking, stuff like that. In direct competition essentially with Paycom. So their revenue streams are usually pretty reoccurring, pretty stable. They have some revenue increase usually during tax season, tax prep. So they might see some fluctuations in like Q4. But let's go ahead and dive into their investor presentation. And we got their earnings up here. Actually, earnings, recurring revenue for the last quarter, up about 19% year over year. Total revenue up about 25% year over year. That's mostly because that interest income that they're earning. And we can see that in the, I think it's in the press release or it's in their 10Q. We can kind of see their income, revenues, recurring and other revenue. They have one line item for 2022, and then they have another one. So we have basically recurring and other revenue at 291, and interest income on funds held for clients, which is at 25. So interest income has seen really like a lot of growth over the last year, just because we've had interest rates rise pretty rapidly, and they're probably holding this in like a money market sweep account, getting probably like 4% interest on it. So you go from getting like 1% or 2% or 1.5% to 4%, and you're going to grow that interest income for the funds you're holding for clients. So went from what's that, like 3x, about 3x, a little over 3.5 over year over year. So getting into their PowerPoint presentation. All right, so we can see 30% CAGR over the last like 4 years or so. They just went into Q1 2023 and had about 25% year over year growth. Going forward, I believe they are guiding for about 20% organic or 20% reoccurring revenue growth. Let's see if we can find that here. And yeah, right here we have their second quarter and their fiscal year 2024 guidance. For fiscal year 2024, they're guiding in the range of 1.4 to 1.41 billion, which represents 20% revenue, 20% growth over 2023 in revenue. So yeah, about 20% top line growth, which is a slowdown from their historical growth of about 25%. So maybe we see a little bit of a retraction in growth. The market overreacts, oversells it, beyond what I would say is like historical valuation multiple based on their growth, and it might turn into a buying opportunity. I think I did a live stream with Andrew on this. When we went over it, I think my point of interest was right around 150, but we'll see what we come up with when we go into the valuation later on. So getting back to the investor presentation, good old TAM. We got TAM. I realized TAM of 18.6 billion. Hey, that actually sounds like it might be realistic. Over 1.3 million businesses in the range of 10 to 5,000, which is kind of their sweet spot for the market that they're targeting. And they reiterate that here. You can see kind of their target is SMBs 1 to 50 all the way up to, probably around 5,000 employees. So they're going to be competing really with like Paychex, Paycor, Paycom, that other one. So, and Paycom's kind of interesting because with their Betty product, they're seems like they're going for those larger clients. So it'll be interesting to see if Paycom kind of targets this 5,000 plus area or these larger clients, then Paylocity might have less competition in the space. So, which could work out good for both of them, assuming Paycom is able to actually get those clients at that higher employee count range. They could unlock a new avenue for growth, and then Paylocity could potentially have less competition in their market right now of that 0 or 1 employee to 5,000 employee companies. Okay, most modern HCM platform. Recruiting, onboarding, benefits, time, labor, payroll, human resources, learning, performance, compensation, global. So yeah, just your typical HCM offerings, insights, recommendation, AI, guys. We got AI, so it must be good. It must be good. Which, funnily, like AI actually might be able to plug in well and help them. Maybe. Well, no, Betty wouldn't really be considered AI. Betty is probably just considered the easy interface to offload a lot of the work onto employees directly. So, but that's for Paycom, not Paylocity. So, HR tools for the modern workplace, on-demand pay, community video, learning, surveys. Okay, yay. ADP, Paychex. Right here, in-house solutions, go-to-market strategy, 820 reps in fiscal 2024, up 18% from 694 reps in 2023. So it looks like they're increasing their workforce, probably going to be hitting the sales a little bit more. But man, it's kind of interesting, and I've said this with Paylocity and Paycom before, is if we get into some type of kind of like a economic macro contraction and tightening of spend across SMBs, then they're probably not going to want to change payroll providers or HCM providers. So if we do see that contraction into maybe a longer, slower rolling recession in certain areas of the economy, I think this could probably be a pretty good headwind to both Paylocity and Paycom. Because they're probably not going to want to go through the pain in the butt of switching HCMs during that point, and potentially bringing on higher increased expenses, one-time expenses for that migration. On the other side, if Paylocity is way cheaper than Paycom, which Paycom, from what people have told me, it seems like Paycom can be 2 to 4 times as expensive as Paylocity. So maybe those penny pinchers will go to Paycom. But in general, this is a pretty sticky business and it's hard to migrate away from. So I think personally that, most likely the frequency or the rate of change within their customer base in that type of macro economic condition where we have slowing in the economy in the SMB space, it'll probably just result in things freezing up more and not as much client shift from certain providers to other providers. 90%, 92% net revenue retention. Okay, cool. So they're having a pretty good retention rate, but so that means they have an 8% churn rate. So 8% churn is still pretty good, actually. I wonder if the other HCMs give us that type of data on what their churn rate is. Revenue, 28% CAGR, yippee yay. Nobody cares what happened in the past. Looks like they're guiding for about 20% going forward. And this could just be one, especially with the recent price action where the market's starting to be like, yeah, maybe they're not going to grow at 28, 30% forever. Maybe we're going to actually have a slowdown. And that's what's really difficult about buying some of these growth machines. If they get re-rated, the re-rating can just be absolutely horrific, as we saw with Paycom. That thing got re-rated hard. So diversity, equity, inclusion, yippee. So let's go ahead and let's jump into the financials. And we can see here, actually, let me go ahead and make this a bit smaller so you guys can see. Cool. All right. So we see, obviously, over the last 10 years, we've had a very, very, very nice trend of revenue growth over the last 10 years. Even though over the last, 5 years has been pretty solid. And it's interesting that we saw all of this growth out of 2020, out of COVID, because you think of like cheap money, stimulus, SMBs were doing really, really good. And in my mind, I'm thinking maybe that leads to more openness to add a HCM or switch ACMs. So yeah, I don't know. I wonder how this is going to play out. That's very curious. Very curious. We got, let's see, expenses basically, rising in line as revenue rises. Weighted shares outstanding, not really increasing a ton, but increasing a decent, at least at the start, like 10 years ago, and it's kind of flattened off. A balance sheet, So we have total current assets, total current liabilities. So total current liabilities about 2.6 billion right now, it looks like. And assets is 2.9 billion. So that spread, their cash on hand is probably just the deviation of that spread, 305, because most of their assets are those, and their liabilities, right? Most of their assets are those funds held for customers, and that's why we have like really, really high total current assets and total current liabilities. So their funds held for customers is probably right around that 2.6 billion mark, and that is the amount that they are earning interest on. And what has been a tailwind to them over the last, I don't know what, like year or so, probably a year. It's kind of been a tailwind to their revenue growth from increased interest rates and getting more interest income off of those funds held for customers. Free cash flow statement, we can see free cash flow and operating cash flow has been growing at a pretty good clip. Let's see, stock-based compensation, pretty hefty stock-based compensation, but nothing insane. Actually, oh yeah. That SBC compared to free cash flow is actually pretty high. So, I don't know. That's a little worrying. I don't know. We'll see what the SBC is when it comes to our evaluation, but that is a decent amount of SBC compared to their free cash flow for sure. Ratios and metrics, we can see that their gross margins, operating margins, net margins have all kind of increased over the last 10 years. They've kind of held pretty flat since, say, 2018, 2019. A little bit of inter-year cyclicality within the quarters. Per share metrics, we see the net income per share and the operating cash flow per share growing as well over the last 10 years. Let's see here. Here's on a yearly basis. Per share metrics on a yearly basis. Yeah, so over the last year, they've had about $5 in operating cash flow, $3.87 per share in free cash flow, net income per share about $2.52. So buybacks, not really a buy backer. Enterprise value and market cap has pretty much remained in line. So they don't really have a lot of debt. Most of the debt that they have is just those funds held for customers. They have a decent cash balance as well. So growth. Yeah, we can see their growth, especially their growth in 2022. 2023 was pretty dang solid. So interesting, they had like declining growth going into 2021 on a year-over-year basis, and then they just like shot up like crazy in 2022 and 2023. If they pull back into this, if they pull back into this 20 to 15% revenue growth area, even if it's from like a cyclical pullback in the economy and SMBs, look out. This could get fun. It could probably go under $100. That's crazy. All right, so yeah, that pretty much breaks it down. Let's go ahead and jump into the valuation template. We're going to go over into market cap, and let's just look at some of the historical valuations, the yearly numbers. So revenue, free cash flow, net income, EBIT, all growing at really healthy pace. Really picking up in 2021 or 2020 to 2023. Yeah, so, and then we can see the margin expansion over that time as well. Over the last 10 years, margins going from about 49%, gross margins, that is, 49% up to about 69%. 69%. So, and free cash flow and net margins were negative, and they kind of seem to be moderating between, well, at least net income around that 11% margin area pretty steadily over the last like 5 years. Free cash flow and operating margins have varied a little bit here and there. Free cash flow margin sitting at about 20% right now, and operating margin sitting about 15.27 according to the data that I have. So, and this is where it kind of gets interesting. We look at the bottom line yields, and this is basically just a valuation multiple that the equity is returning on a market cap basis. When we look at their free cash flow, their net income, their EBIT, and then compare it to the 10-year treasury. So obviously 10-year treasury has rallied. Well, depends on how you look at it. The yield has rallied up at about, I think we're closer to 5 right now, or maybe it's 4.23, but I've got 4.23 here right now. Free cash flow yield for Paylocity is sitting about 3% right now, 2.3 for EBIT, and 1.7 for net income, which is pretty much the best valuation, or the lowest, the highest yield valuation that's had over the last 10 years. But does that make it a buy? No, it doesn't. It does not at all. It is getting more interesting, though. More interesting. Very similar to Paycom, right? So we can see the dilution looks like they probably did an acquisition or something like that in 2014. And then we've had a little bit of a dilution, but nothing too major over the last 5 years since around 2018. Maybe a couple percent in dilution. Let's see. Let's go to operating cash flow, dividends paid, net income, common stock repurchased. Yeah, so good operating cash flow growth. Man, what is that? Is that correct? That is a huge jump in operating cash flow from 2022 to 2023. Net income growth, decent. So, all right. 5-year averages, we can see. Let's see. Bottom line growth over the last 5 years is about 38%. For this, we're not going to normalize. Yeah, let's not normalize. And then we're gonna look and see what their growth has been over the last 5 years. EBIT growth has been 56, net growth has been 29, free cash flow growth has been 29. Let's see, revenue growth has been 25, but we know that they're projecting more like 20-ish% revenue growth for 2024, so we should probably put this down at least to around 20%. So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. All right, so we went ahead and played around with this. We got yields essentially in scenario 1 of 4% on a valuation basis. Scenario 2 is 3.5% valuation basis. Scenario 3 is 3.04. Scenario 4 is 2.64. Scenario 5 is 2.3. And then we look at the bottom line growth assumptions, and we're not normalizing. We're not picking out any specific metric. We're just looking at the growth over EBIT, free cash flow, and net income. And we're projecting anywhere from 15 to 25% growth, with about 20% being the median. So in a standard case, we're looking at 19.59. Scenario 1 is 15.11. Scenario 2 is 17.2. Scenario 3 is basically what management guidance is for 2024, although we're projecting that over 5 years. So if it kicks up or obviously slows down, that's going to change the way that we would value it. Scenario 4 would be 22.32, and scenario 5 would be 25.42, almost a resumption back to a higher growth rate that they were previously experiencing. On a dilution basis, we basically have dilution from worst case scenario 1.08% to a best case scenario of 0.62%. And right now we are targeting a base CAGR of 15% with a margin of safety of 2.5%. And what that gives us after all of this is ran is a scenario 1 buy price of $72, a scenario 2 buy price of $92, scenario 3 buy price of $118, scenario 4 buy price of $153, scenario 5 buy price of $200. And what we can see previously, this was most likely it was priced out for these upper end scenarios, some of the better case scenarios. Look at the overview. It traded, from 2020 to 2023. It's traded up above 200 a lot. So, yeah, I don't know. We shall see what happens. But the high was 301, which is just crazy. It's very rich. I'll just say that it's very rich. So we look at the template, the 5-year targets under these various scenarios. If all of this was to play out, 5-year target for scenario 1 would be $166. 5-year target for scenario 2 would be $211. Scenario 3 5-year target would be $270. Scenario 4 would be $350. Scenario 5 would be $459. So obviously, if you wanted to have a higher target CAGR, it would decrease your buy prices because your end assumptions aren't increasing. It's just your target assumptions for your target CAGR are increasing, pushing down your buy prices. So, but yeah, I don't know if this is one that I would say, oh yeah, I want to get like a 20% CAGR off the projection, just because the revenue streams are so stable. Although, as we've seen with, Paycom, a little chink in the armor, a chink in the thesis, and everything can kind of get destroyed. So this is definitely one that I'm going to be watching along with Paycom, just to see, how this plays out. I think it's in a pretty interesting area right now, honestly. If you were to put some of these yield valuation multiples into a more historical lineup, or historical basis, then we would probably get closer to a buy price in our current area. Or if you even just like resumed or removed any type of declining growth, and you were like, yeah, this is gonna best case scenario resume the 38% growth, which would mean they would have to do probably like 25% top line growth with further margin expansion. Operating efficiencies would have to expand for margin expansion to happen. If you get those two, then maybe you get up to that 35% area. And then if we did a bigger deviation on the scenario spread, let's see, 38% would be the best case scenario to about 20%. Oh, whoops, neg 20. Worst case scenario is about 15. We would be close to a buy point right now in the base case. And that would assume we would have 25% bottom line growth over the next 5 years, which is still pretty hefty. It's definitely not priced for, a weakening or a slowdown in growth over like a potential like normalization or cyclical time from SMBs being a little bit weak. So yeah, I think that's all I got for you guys. Hope you had a great Thanksgiving weekend, and we will catch you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.